Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Thursday the 14th of December. It's Fed Day, the final one of the year, and we have the latest news and analysis from the FOMC meeting. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And in today's business and finance headlines, the US Federal Reserve held the benchmark overnight borrowing rate steady at a 22-year high in the 5.25% to 5.5% range and forecast 3 rate cuts in 2024. Projections released after the bank's meeting showed they expect its median key interest rate to stand at 4.6% next year, around 75 basis points lower than the current rate. The Fed's quarterly dot plots, revealing the interest rate forecasts of committee members, show no members now expecting further rate rises. A new deal has been agreed at the UN Climate Summit in Dubai after days of negotiations. For the first time, the deal calls on all countries to move away from using fossil fuels, but not to phase them out, something many governments wanted. The latest proposal, published by the summit hosts, the UAE, earlier on Wednesday called for transitioning away from fossil fuels in energy systems in a just, orderly and equitable manner, accelerating action in this critical decade so as to achieve net zero by 2050 in keeping with the science. The Bank of Japan's quarterly Tankan survey showed that sentiment among large Japanese manufacturers improved more than expected in the fourth quarter, while sentiment among big non-manufacturers improved for the 7th quarter in a row. The Bank of Japan's index for big manufacturers' sentiment climbed to 12 in Q4 from 9 in Q3, pointing to the highest print since the first quarter of 2022 and exceeding market consensus of 10. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and John Schofield, Managing Director of Tempus Investment. And with a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. Please keep your questions and comments coming. I do read all of them. You can post them on my website, peterlewismoneytalk.substack.com, or on my Facebook page, Peter Lewis Money Talk. And on X, I'm at Money Talk R3. On Wall Street Wednesday, US stocks surged after the Fed forecast 3 interest rate cuts in 2024. The Dow closed at a record high, jumping more than 500 points to close above 37,000 for the first time ever. The 30-stock Dow added 512 points, or 1.4%, to end the session at 37,090. That was virtually the high point of the day. The S&P 500 jumped 1.4% to finish the session at 4,707, with utilities and real estate shares leading the way. All 11 S&P sectors closed in positive territory. The Nasdaq Composite climbed 1.4% to 14,734. US Treasuries staged a historic rally and yields dropped as comments from Federal Reserve Chair Jerome Powell helped extend the rally that began after the US Central Bank published a more dovish outlook than investors had anticipated. The yield on the policy-sensitive 2-year note ended the session down 27 basis points at a 6-month low of 4.46%. That ranked as its biggest daily drop since the collapse of Silicon Valley Bank in March. And at its intraday low, the 2-year yield was down 30 basis points, which would have ranked as its 10th largest one-day move this century. The 10-year yield hit its lowest since August, hovering just above 4% at 4.03%, down 18 basis points on the day. The US dollar index fell 0.8% to below 103 on Wednesday, the lowest level in over a week. The yen was the biggest beneficiary of the US dollar weakness, surging 1.7% to 143 yen against the dollar. The euro was 0.8% stronger at 1.08 3/4. The offshore yuan slipped towards 7.20 renminbi per dollar in Asian trading, hovering close to its lowest levels in over 3 weeks as a policy meeting of top Chinese officials, where they set economic targets for next year, provided little boost to the market. However, after the Fed decision, it surged 0.8% to 7.13.5 renminbi per dollar. Gold soared over $40, back above $2,000. It ended the session 2.3% firmer at $2,025 an ounce. Oil prices recovered from falls in Asian trading Wednesday that took them to 6-month lows. Brent crude futures for February rose 1.4% to settle at $74.26 a barrel, and Bitcoin jumped 3.8% to $42,800. Year to date, Bitcoin has gained over 158%. Hong Kong stocks and mainland China A shares fell as investors expressed disappointment with the outcome of this year's Economic Work Conference. In Hong Kong, the Hang Seng dropped 146 points or 0.9% to end at 16,229 on Wednesday. The index hit its lowest level in over 13 months. The Shanghai Composite fell 1.2% to close at 2,969, erasing gains from earlier in the week. And it looks like the Hang Seng is going to open about 135 points higher. That's around 0.8%, starting the day at about 13,363. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On our Fed Day, pleased to welcome our panel of guests. We have with us Andrew Freris, the CEO of Ecognosis Advisory. Morning to you, Andrew.
Good morning. Good morning.
And also with us, John Schofield, who's Managing Director of Tempus Investment. Good morning, John.
Yes, hello. Good morning, Peter.
So the US Federal Reserve, as you heard there, held the benchmark overnight borrowing rate steady at a 22-year high in the 5.25% to 5.5% range, and they forecast 3 rate cuts in 2024. They expect the median key interest rate to stand at 4.6% next year, about 75 basis points lower than the current rate. And the dot plots show that not a single member on the FOMC now expects further rate rises. In coming to its decision, the Fed noted in a statement after the meeting that the growth of economic activity has slowed from its strong pace in the third quarter, and inflation has eased over the past year but remains elevated. And in a press conference after the announcement, Federal Reserve Chairman Jerome Powell said that the Fed is now seeing progress on inflation across the 3 main core areas. And he said the Fed's willing to cut rates, even if the US economy doesn't dip into a recession in 2024. Mr. Powell said it could just be a sign that the economy is normalising and doesn't need tight policy. And he said the question of when it will become appropriate to begin dialling back the amount of policy restraint in place is clearly a topic of discussion out in the world, and also of discussion for us at our meeting today. So, Andrew, this is quite a big turnaround, isn't it, for the Fed?
Yeah, actually pretty massive. And reading the details, it seems to be a little bit contradictory. They seem to be wanting to have it both ways. First, suddenly, we're going to have 3 cuts out of nothing. Then Powell says we're not going to see inflation at 2% till the year 26, read my lips. Okay, well, hang on a minute. That was their target before they will do anything like cutting interest rates. Okay, and then the rest of it is a little bit sort of and ah. The economy is doing much better without a great deal of inflation, and therefore, you know, it looks vague, and I find it very unsatisfactory in terms of explaining something. You know, out of nothing, we have 3 cuts in interest rates. And of course, he says there's nothing to stop us, of course, of increasing interest rates should this be necessary. Well, thanks very much. Will it rain tomorrow? It might rain, it might not rain, and it might be very dry. Okay, so 100% accurate forecast.
It's a bit odd, isn't it? Because at the last Fed meeting, Jerome Powell was saying almost the complete opposite, trying to dampen down expectations of rate cuts. Now, not much has changed between last meeting and this meeting, but suddenly now all that's gone out of the window.
It's a helpless task. I don't feel particularly sorry for them because they get paid to do it. But it's a little bit humiliating for all of us grown-ups trying to guess what the Fed is going to do, and then the Fed does something that none of us is going to be surprised. But equally, we are a little bit aghast. It sounds not serious.
John, are you surprised? Are you aghast? What do you think?
Yeah, I'm slightly surprised at how dovish he seems to be talking now. I mean, the main thing is the to get inflation down, you need to have real interest rates of at least 1% above the current rate of inflation. So I suppose on that basis, you could argue that starting to ease a little bit during the course of next year, provided inflation stays, below 3%. But it's also true that the last mile is their core inflation rate, 4%. They need to halve that. It gets as inflation falls towards the target, the rate of progress slows down, and it gets harder and harder to squeeze that last little bit out. So, in the past, people have raised the question of whether the 2% target really is the right target. So I don't know whether they're starting to, and as long as it's falling even very slightly, and is below 3%, then they'll be happy with that.
Well, what I don't really get out of this is the Fed saying that they think inflation is going to get down to target at 2%, and therefore that's going to give them the leeway to cut 3 times next week? Or are they saying it doesn't matter? Even if it doesn't get down to 2%, we're still going to cut 3 times next year? I'm not really sure which one they're saying.
Yeah, he did seem to be saying the latter, which, as Andrew said, is a bit of a strange approach. Yeah,
it's all odd.
I mean, up to now, I've always been saying the Fed have been very consistent for the last 2 years or so since they had their sudden pivot towards fighting inflation, and this seems a little less consistent.
Andrew, is inflation under control, do you think, in the US, so that it does justify rates coming down?
Pathetically, that depends where is your target. Now, if your target was 6% inflation and it's now down to 3%, it's definitely under control. If your target is 2%, and simultaneously with what else? You're telling us that you are not going to get inflation at 2% till the year 26. Hang on a minute, that's the year 24, that's the year 25, and then that's the year 26. In sort of kind of theoretically 3 years' time, then the whole thing becomes, completely such a subjective issue that one should not waste his time. If I think that inflation should be 6% and it's now 3%, of course it is under control. If I think that inflation should be 2% and it's under 3%, and it is effectively 1/3 where it should be, then it's not under control. Then as I said, I find it almost a thing that adults shouldn't get involved. Not it is ludicrously sexy, but it is kind of a game for kids. I mean, I find it childish. Yeah, but that's the way it is. We're being paid to do childish things, Peter.
Has the Fed lost control of the narrative here? Because it spent all year pushing back against the markets, hasn't it? And it was pushing back against the markets very aggressively at the last meeting. And we ended up in the situation where the markets were predicting 1% of rate cuts, and the Fed was saying none at all. But now the Fed seems to be racing to meet the markets rather than the other way round. And the markets are now getting even more aggressive. They're now saying, well, actually, it's going to be 1.5% next year.
Yeah. Yes, well, the market. Yes, I mean this has been the pattern throughout. The markets will always try to lead the Fed by the nose. Certainly, what 1.5% cuts seems wholly unridiculous, unless, and perhaps they know something we don't, that the recession is coming. He did make some comments about saying that there was still a risk of recession,
or maybe deflation's coming.
Yes, and also that's a factor of the wave of deflation coming from China. Maybe it hasn't reached the US yet, really. Although we're starting to see that, falling commodity prices, as well as.
The thing perhaps that we may not consider is that the Fed is cutting interest rates because that's going to help Biden. Actually, my understanding from what, in inverted commas, like a good student I have read, is that Fed pre and post election behavior is completely unpredictable, meaning that they don't cut interest rates as we're coming up to an election, or then they feel once the election has taken place, then they feel much more relieved to go ahead and increase interest rates because the election is out of the way. So in other words, I would not read, if I was a Trumpian, that the Fed is trying to support good old Biden by making both the markets and the environment considerably happier as we go on towards the November election.
Mm. There's always the possibility here, isn't there, that just like the Fed made a big mistake a couple of years ago when inflation first took off and said it was transitory and then ended up having to slam on the brakes, that it's now making another historic mistake and cutting rates too early and may see inflation go and spike again, which will then mean it will have to go and reverse itself, perhaps.
Look, I don't see in the very basic macros as they stand, which unfortunately I'm not even looking forward. I was simply looking at the trend as it develops in front of my eyes, and I'm not extending it. I just can't see something that suddenly is going to reverse the inflation and shoot it up from 3%, which now back to 6% or 7%, back we were in those good, bad times that the Fed had to go from when it started in March, I'll get this right, in March 22, to hike and hike and hike and hiked again. It went from 0 to 5.5%. Yeah, I just can't see what it could be there that will make the economy go back to a 6% inflation rate.
John, is this
certainly it seems very unlikely. I agree that it's very unlikely to do, but a slight. Previously they would have been concerned by even a slight uptick. They're now sort of saying, well, it's going to. So as I say, it's more a question of how determined they are to squeeze that last percent or so out from the inflation, if we can get back to 2 or below 2. And what they seem to be saying, they're not quite such a big hurry to do that. Now,
the one thing that Jerome Powell didn't talk about, which he did talk about a lot at the last meeting, was now this massive easing of financial conditions. At the last meeting, he was talking about how financial conditions were tightening and were doing part of the work for the Fed and in effect raising rates for them. And he said this was a good thing. Well, that, of course, the moment he said it, now went into a complete reverse. And we've had this massive easing of financial conditions. But he didn't say anything about that at all, and that could maybe cause them to pause cutting rates. What do you make of that?
Yes, I was going to say that the Chicago Financial Conditions Index has actually been showing that conditions are loosening. In fact, have been doing for several months since I think July. It peaked at near neutral, and it's been on the slide ever since. So. Clearly that was, and that's probably the market. We've seen volatility in the stock markets fall, credit spreads fall, the rally in the bond markets, and all the rest of it. So it seems somehow the financial conditions have been loosening anyway. So they're probably just saying, well, we'll bring the short-term rate back in line with that. So it looks. The inversion of the yield curve, you've got 10-year yields at 4%, 5.5% short-term rates looks very high. But one of those two is wrong. I personally think that the bond market is way ahead of itself for now. So maybe we'll just again come. The pendulum is swinging around the mean, and we've just seen a big swing above the mean or below the mean, and that will. Come after the traditional year-end rally in markets and all that, will by January, February, we'll see things starting to go normalize again.
Andrew, this has lit a fire under the markets, hasn't it? I mean, with the loosening of financial conditions, with bond yields falling. It was only a month or so ago, back in October, that the 10-year yield was above 5%. I think it hit 5.02%. It's now down at 4%. Jeffrey Gundlach, hedge fund manager, says it's going to hit 3%. What are your thoughts on the way the bond market reacts to this now?
Well, one can play a similar, again, slightly asinine game. Let's say that the markets are telling you that they have a very good feeling about inflation, and that's why they don't mind seeing the yields. In other words, they will be willing to buy into the yields coming down, precisely because the expected rate of inflation is going to come down. In other words, 3% is not yet where it should be. And therefore, Powell might be wrong by expecting that we're not going to see 2% for another effectively 3.5 years. It might happen a little bit faster. Yeah, but put it like that. Is it unbelievably unexpected that the Fed says they're going to cut interest rates? No, because effectively the question was when they're going to cut rather than whether. Okay, so now they're going to cut earlier rather than later. So fair enough. Okay, now was the question whether they're going to increase again interest rates? The answer is much, much less. In other words, the concern of the markets was trying to guess when the Fed will ease rather than when the Fed will hike. So we got it now out of the way. So presumably they can put us back into the toy ring, throw in all our teddy bears and allow us to continue playing a more orderly manner.
So, John, is this a green light now for markets, both for bonds and stocks?
Yeah, I think there's an element of seasonality also. As I say, I'm sceptical about the bond market rally, particularly given the supply. We've got the huge amount of borrowing to come from the issuance to come from the Treasury, plus continued QT. Fed is going to continue to run down its balance sheet. So there's a lot of supply coming out of the bonds, and the brokers and so on are got a lot of bonds to sell. So they're very keen to push the bull story on bonds. As I say, I think we'll get back by, I suppose, is it March when the first cut might or might not take place? So we'll be toying around. We'll be toying around with, at that time, with people trying to second guess whether the Fed's going to go, this meeting or next meeting, and this sort of game, as Andrew describes it quite correctly.
And what about stocks? The Dow's at a record high now. It seems almost certain the S&P and the Nasdaq's going to follow them, doesn't it? It's a much broader based rally. It looks like building up. So I think it's got some, because the interest rate sensitive stocks are responding now. Hence you see the Dow outpacing even the Nasdaq, because that's where the sector rotation is taking place. So there's more upside potential. I'm quite sure for stocks over the next couple of months. But there'll be a reality check at some point, probably February. But even after the first Fed rate cut, which will have been discounted several times over, probably by then. But earnings have really got to come through, haven't they, Andrew, to justify these sort of levels?
Peter, I was looking at my Bloomberg screens here. Hong Kong hasn't opened, of course, yet, and it will be very interesting to see whether the good news as far as Hong Kong interest rates are concerned is going to whiz through, given that we have now one of the worst performing index in the total galactic universe as we talk. Every year going down.
It is. It's down about 18%, the Hang Seng. It is the worst performing market in the world.
It will be nice to... It will be nice to see some good news. Yeah.
Well, there's two competing forces here, isn't there? There's the obviously the good news about Fed interest rates, but at the same time, investors seem to be disappointed with the Economic Work Conference. Not really enthused about what came out of that. What are your thoughts out of that? I mean, there was a lot of talk, another new 9-point plan, but again, not a lot of details and not a lot of indication about how consumer confidence was going to be improved and how consumer spending was likely to get better.
Yeah, it's, again, the thankless task of appearing to be doing things and also planning to be doing things. And then, of course, having to deliver. And I don't want to be either childish or churlish. I still go back 2 months when we had, it was either the 30 or the 31 individual points plan, okay, which effectively it never materialized. It came through in bits, drips and drops, particularly with the sudden spurt of increasing the availability of credit and also changing the conditions that credit was available in property sector and property markets. Okay, but then, as you say, taking these estates further just doesn't seem to be there.
John, you didn't get the impression reading through the readout of the work conference that there was any sense of urgency. If anything, the members were saying favourable conditions outweigh unfavourable factors in China's development. That doesn't suggest that they see very much urgency to take more aggressive steps to support the economy.
Yes, well, it's all around the property debts mountain and so on. I think a big event coming up is whether the Evergrande, bankruptcy trial or whatever you call it, hearing is going to conclude. We're clearly in a situation where we've got all this debt overhang, and that there doesn't seem to be any real appetite to grasp the nettle and start doing serious restructuring and asset disposals and things like that. Probably because of the enormity of the problem. The size of it's so vast. I say if Evergrande collapses in a heap and a lot of bad debts going through the banking system, the shadow banking system, and these trust things and so on, the potential for contagion is obviously there. And so I think in the meantime, it's they're just hoping to muddle through somehow. So we're back to the Japan scenario, the Japan in the 90s scenario potentially on that side of the economy. But then we have this sort of apparently booming manufacturing sector, particularly in the EV and renewable energy equipment and so on. So they seem to be quite happy to focus on that, keep that all booming, exports going, even though that's deflationary. But they're simply not willing, and seems to be a philosophical or issue really for the party, that they're just not willing to go for a consumer-led, and demand-driven economy. Because that looks too much like the West.
Andrew, that seems to be the key issue, doesn't it? They don't seem to want to put money into consumers' pockets to help them, really. They're happy to put more investment into manufacturing and where there's already overcapacity in some areas, but not so willing to help the consumer.
Well, yes, because the obvious thing would have been something that both United States, UK, Singapore, and Hong Kong done, and that is to literally send checks to people. In other words, give them money on which they would spend. Well, you've got 1.3 billion Chinese, and I imagine even the party itself blanches at the thought of, I don't want to use the word printing because that's completely irrelevant. This is simply crediting people's accounts with money rather than spending the money individually. Milton Friedman would have told you the best people that know where and how the money should be spent are the individual consumers. So give it to them and let them get on with it. Okay, but it's easier said than done, and it's not going to be done because this is not something that it is part of the Chinese armory. they grudgingly accepted to increase the fiscal deficit, whereas they could have doubled it from 3.4% to 7% and over. Okay, in other words, borrow a big chunk of money, or rather spend a big chunk of money. Now, of course, where and how they're going to be spent, it unfortunately would have been the usual suspects. Okay, it would have been trains, planes, hospitals, ports, and the property sector. And also that when this was, assuming this piece of paper was ever placed in front of me, they would have actually said, really? Not likely. Thank you very much.
John, an interesting headline this week. The value of India's stock market's overtaken Hong Kong. The National Stock Exchange of India is now the world's seventh largest stock market, has a valuation of about just under $4 trillion. Is this a significant milestone, do you think?
It is for India. I don't think it's a big negative for Hong Kong. But India is the emerging market, and is has a much freer, in many ways, a much freer economy than China, and of course it's growing. We're in the 8th or 9th year of this bull market in stocks. There are many consumer-driven stocks and so on, which have boomed really in India. So. I think it's going to continue, and the Hong Kong has really its own issues. I think it's.
Peter, we're going to run
more
out
than
of time, and you're not going to ask us about COP28.
I am. I'm coming on to that in a moment. Give me a moment.
Don't worry, you get it. You get it. But no, just going back to the Hang Seng Index, hopefully, if interest rates are starting to come down, that will give the parts of the Hang Seng, the Hong Kong blue chips, interest rate sensitive banks, and maybe even a little bit of a fillip for the property market here domestically. But obviously, the overhang from China, which is now the dominant stocks in the index, is another matter.
Okay, well, Andrew, here's your chance then. COP28 ends with a deal to transition away from fossil fuels. My question to you is this. There's been a lot of debate now about transitioning away from fossil fuels, which is what this deal calls for, as opposed to phasing them out. Is there much difference between the two? Is this semantics, or is it an important difference?
I think it is absolutely meaningless statement, because if you ask any economy whether they are transitioning into using more fossil fuels, they will be horrified, because they don't. Okay, even China, who is actually using more coal than it was before, proportionally to the amount of energy that's being produced by electricity vis-a-vis is being produced by renewables, it's actually relatively declining. So all economies are transitioning away from fossil fuel. The difference, Peter, is they use the word fossil, arg. Before that, you could not say fossil in a core meeting. And also, I find this incredibly childish. Yes, big news. We are now supposedly transitioning away. We have been transitioning away in different paces and places. And also to throw into that also, hopefully by year 50, we're going to have a net zero without defining what net zero means, okay, left me absolutely nonplussed. It's great. Okay, they are working very hard at it. I liked all the little bit of details, particularly rubbishing carbon credits, okay, because a great deal of it, they really need rubbishing because they are also pretty meaningless pieces of paper. So there was a lot of nice chewy bits. I'm not being ungrateful here, but the main conclusion of that is we are transitioning away from fossils. I thought, really? I didn't know that. I hadn't noticed. Thanks very much for telling me.
John, your final thoughts from you on COP28. Was it a disappointment, or what are your thoughts?
I didn't have a great expectations either. I think the main thing is to focus on the fact that, the markets, technology, economics, market forces are anyway accelerating the transition, or whatever you want to call it, away from fossil fuels. One disappointment is that they don't distinguish between fossil fuels. I mean, coal is, horribly polluting, dangerous fuel, and terrible source of air pollution as well as carbon credit. Vis-a-vis natural gas, which is relatively clean, and a lot of economies have been talking about using natural gas to fill the gap during the transition away from fossil fuels also. So I'd like to see more done in that direction.
Okay.
But otherwise, I think we can be reasonably optimistic that the fact that China and the US are both racing, towards all the technologies that needed to achieve net zero are well underway.
Okay, well, thank you for your thoughts there. Great discussion this morning. You heard there John Schofield, who is Managing Director at Tempus Investments, Andrew Freris, who is the CEO of Ecognosis Advisory. I'm joined now by Ross Feingold, who is Business Development Director at SafePro Group over in Taiwan. Good morning, Ross.
Good morning from Taipei.
And we've been talking about the Taiwan election recently. It's coming up very imminent now, isn't it, in January? I've got a question from a listener, Bruce Simon, who has posted on my website, peterlewismoneytalk.substack.com. He said, can you ask Ross Feingold what young people in Taiwan think about the prospect of a third-party candidate winning the presidential election in January? And also, what are the candidates' positions on the USA and China? So, Ross, what's your answer to that?
Oh, thanks for the question. When we talk about young voters here in Taiwan, people typically look at two age cohorts, the 20 to 29. The voting age is 20 here. So they look at the 20 to 29 cohort and the 30 to 39 cohort. From some of the polls that do break out the respondents by age, it seems that Ko Wen-je of the Taiwan People's Party does pretty well with both the 2029 and the 30 to 39, but maybe a little bit better with the latter, with the 30 to 39. And the 20 to 29 group did go for Tsai Ing-wen and the Democratic Progressive Party in big numbers 4 years ago. Again, some of them may have shifted their support to Ko Wen-je, but if they think Ko Wen-je has no hope of winning as we get closer to voting day, which is now 30 days away, it's possible that they'll shift their votes back to the Democratic Progressive Party and its candidate, William Lai. All of that's just another way of saying that the Chinese Nationalist Party, or the Kuomintang, they tend not to do very well with the younger voters, whether it's 20 to 29 or 30 to 39. As for China, I think we would expect that William Lai, if he wins, he's going to continue Tsai Ing-wen's policies, most notably when it comes to China, that they will not agree to the 92 consensus that there's one China, but each side defines it differently. On the mainland as People's Republic of China, here on Taiwan as the Republic of China. So chances are, if Lai wins, he'll continue that policy, and he'll continue to look to really deepen relations with the U.S. the way Tsai Ing-wen has done. And at times, Tsai Ing-wen has and her administration has had some really good successes with bilateral relations with the United States, spanning both the Trump and the Biden administration. If the Kuomintang wins, they'll probably look to return to the 92 consensus as the basis for cross-strait relations, very similar to when Ma Ying-jeou was president from 2008, 2016. But they also say that they'll continue to prioritize the relationship with the United States as the most important relationship in the foreign policy space. And for the Taiwan People's Party, they haven't endorsed the 92 consensus, but they often talk about opening up more dialogue with China and not being so absolutist as the DPP is when it comes to these issues. And then similar to the Kuomintang, though, the Taiwan People's Party still emphasizes that the most important bilateral relationship is with the United States.
And do the young people see the Taiwan People's Party as being sort of genuinely in the middle somewhere between the DPP and the KMT? Are they successfully carving out that space for themselves?
It's a great question. The answer, unfortunately, is going to be yes and no. Yes, in the sense that they say they are. They say they're not the Kuomintang and they're not the Democratic Progressive Party, that they are middle of the road and that they're just very focused on finding good solutions to various issues, whether that's economic issues, housing justice, the cost of childcare, the typical economic and social issues that people will argue about in an election in any democracy. But if you ask young people to articulate the DPP's policies, they're probably not going to know them, because ultimately, when it comes to issues other than the relationship with China, frankly, there's not a lot of difference among the political parties here. They're all very much like a European social democratic party. They're left of center. They are all in favor of a nanny state. And basically, whether it's on the environment or housing justice, other social issues, their policies are all very, very similar. It's not like one party is for smaller government or is libertarian. That's definitely not the case here.
And I suppose young people in Taiwan, not much difference from young people in other parts of the world in terms of what they're focusing on. They're worried about job prospects, slowing income growth, the fact they can't afford housing, and so on. Are they similar issues for Taiwan?
Absolutely. And the cost of housing is really probably the number one issue for young people. And that's combined with low wages. So Taiwan's, for many, many years has had very slow growth in wages, especially at the bottom of the scale for entry-level workers, including young men and women who have tertiary education. The starting salaries tend to be very, very low. And I'm referring to white-collar jobs in the services industry. The salaries tend to be very, very low. And with the cost of housing increasing so much in recent years, it just looks very difficult from the view of a young person that they'd ever be able to afford to buy a home. So that's definitely been one of the key issues in this election.
And what are the polls saying? Is this a close three-way race, or is anyone pulling ahead?
Well, one thing that's been consistent with the polls is that William Lai of the Democratic Progressive Party has had a consistent lead throughout this campaign season. Now, his lead, though, is typically no more than polling about 35%, sometimes a little less, sometimes a little more, but generally it's been around 35%. And then the other two candidates have either polled around 30, 31, 27, somewhere like that. What's interesting, though, is some polls will put Ko Wen-je of the Taiwan People's Party second. Some polls will put Hou You-yi of the Chinese Nationalist Party as second. So that sometimes flip-flops in different polls. There was one poll from a relatively respected pollster earlier this week that had Hou You-yi of the Chinese Nationalist Party, or Kuomintang, in second place and within 3%, so puts him in the percent of error there. And it seems that the Kuomintang, in my own conversations with party officials, they are still optimistic. They still think that the polls indicate that if Ho can find some momentum, he could win this election.
There was an interesting article in the Financial Times this week about the role of Taiwan's semiconductor manufacturing company in this election, something that really I hadn't really thought about, I have to confess. But nevertheless, TSMC is just so dominant in the Taiwanese economy and on the Taiwanese stock market as well, that it's sort of sucking resources, this article says anyway, out of other areas of the economy. And that's a concern as well for voters. Is that something you're detecting? Is it something that's being talked about?
I wouldn't say it's being talked about by voters or on television political talk shows. I mean, everyone knows the role TSMC plays in the Taiwan economy, even if they can't articulate it in dollars or its percentage of exports that the semiconductor ecosystem represents. But people know it's crucially important. What usually gets news here is when some foreign scholar says something like, "Well, we should put ordinance ordnance at TSMC's fabs so that it could be blown up in case China invades. And there's been a few foreign experts who have suggested that in the last couple of years. So that's something that everybody has probably heard of. And I don't think many people here agree with doing that.
Okay, let me just switch topics for a little bit. President Xi Jinping was in Vietnam for a 2-day state visit this week. It's his third trip to the country since he became Communist Party General Secretary. How important is this relationship to China? Because it's significant, isn't it? Because the US is also trying to develop stronger relations with Vietnam.
Yeah, there's so many different angles to the visit and the relationship. I mean, one that gets so much media attention nowadays is the territorial disputes in the South China Sea, where Vietnam, just like Malaysia and Indonesia and Brunei and the Philippines and Taiwan, have territorial disputes, sovereignty disputes with the People's Republic of China. And Vietnam does occupy several of the disputed islands in the South China Sea, and to some extent has militarized those islands the way China has militarized some of the islands that China occupies. On the other hand, we all talk about friendshoring or China plus one, and Vietnam has been a big beneficiary of that. It's built up a lot of infrastructure, manufacturing parks, science parks, these kinds of things to try to support some of this manufacturing that's leaving China and present itself as an alternative to present itself to American companies or European companies as an alternative manufacturing location. And Vietnam has definitely had some successes in that. However, a lot of that supply chain still is Chinese connected. So it could be some components will come from China to Vietnam, or Chinese companies that are part of the tech supply chain, they'll open up operations in Vietnam too. And there's been a lot of that as well. So some of the suppliers, especially for tech products that are Chinese suppliers, they look at Vietnam as a destination they need to be in, just the way Western companies might. So maintaining smooth trade relations and non-discrimination against Chinese companies, that's something important to the Chinese side when they're engaging with Vietnam. And then the third thing I'll mention, and it's still relevant to some extent, is they're both communist countries, and the club of communist countries is not very large. So at some level, there is, I think, a desire to maintain some fraternal brotherhood among the dwindling number of communist countries worldwide, and Vietnam and China being neighbors and being communist countries, and some memories of better times perhaps when China did help Vietnam in the Vietnam War. I think there is still a desire to have some good relations just based on the shared political system and shared history.
Ross, thank you very much indeed. Great to talk to you as always. That's Ross Feingold, who's Business Development Director at SafePro Group over in Taipei in Taiwan.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening to Money Talk this morning. Do please take a look at my newsletter, which you'll find at peterlewismoneytalk.substack.com for more information on developments during the Asian trading day. I'll be back tomorrow with the final Money Talk of the week, when I'll be joined by Corinne Hearn, Partner and Chief Sustainability Officer at East Capital Group, and Louisa Fock, China Equity Strategist at the Bank of Singapore. With a view from Australia is Toby Lawson, the CEO of Staten Partners. Have a good day.
Money Talk.